The Insurance Pro Blog Podcast, episode number 124. Fixing the way we talk about whole life dividends. Hello and welcome. This is the Insurance Pro Blog Podcast. It is Thursday, September 27th, 2018. This is episode 124. I am Brandon Roberts.
And I am Brantley Whitley.
And what do we want to talk about today? Insurance, the weather.
Well, evidently based on the raving success of the Tefra Defra podcast, we need
taxes and insurance. That's the winning combination.
We need to talk about boring and obscure insurance tax law because that's evidently what people want to talk about. Mm-hmm. So we decided we're not going to talk about that at all this week.
So we're going to rename this whole thing the Insurance and Tax Robot.
Yeah, exactly. Well, because we're really crafty, we've decided to dovetail nicely off of last week's podcast. We're not going to talk about taxes in any way, shape, form, or fashion. So,
well, certain subjects get boring after a while.
Yeah, we got to put a week in between at least. Yep. But we're talking about everyone's next favorite thing to talk about, which is dividends.
Whole life insurance dividends.
Oh, how many questions?
And you know what? Cue the edgy music. It's late September, which means it's soon to be October. Which means we are like a month and a half away from dividend season, baby.
We're a month and a half away from a month and a half away of dividend season. Yes, exactly. It will be dividend season. Whatever that means. I predict there will not be much excitement. There will be much gnashing of teeth, probably.
We've got Liam. We've got the fourth quarter of the year, and we've got dividend season.
Yeah.
This is high time for excitement for the insurance industry.
Yep.
I'm trying really hard here, by the way.
I know. I can tell. You're really trying to pump me up here. Mm-hmm. But everyone does like talking about dividends.
Yeah.
Gosh, if I probably, went back and looked at all of the questions that we've received since we started this thing, 6 and 7, depending on when you started calculating.
Yeah.
6-7 years ago. I would say that's probably one of the more dominant questions that we've gotten in terms of something relating to whole life insurance dividends.
Right.
It could be a lot of different contexts, obviously, but it's the great mystery, and it causes more confusion than it needs to, in my opinion. But
yep,
we're going to dive into some of that today.
So let's talk about the dividend scale or the dividend interest rate.
Are those the same thing? I'll start with the first question.
Depends on who you ask. And the elimination thereof.
Okay.
Okay.
So we're going to eliminate the dividend scale.
Why not? We're just going to get rid of it.
I think it's probably your crowning idea.
So as industry professionals know, and certain consumers know,
and then there's us. Yes.
Yeah. Every year, sometime around the end of the year, most life insurance companies engaged in the manufacturing of participating whole life insurance announce their dividend scale or dividend interest rate, which is kind of different, but lots of times those terms get used almost interchangeably.
Right.
And
some decide
so-
to announce and some decide to hide. It just depends.
when the news was good, we announced, and when it was
Yes,
bad, we just kind of made a
exactly.
mumbling about insurance is gonna.
Or we give the total
So-
number of dividends paid, but we don't talk about scale or anything like
not
that.
important. Not
Right,
important.
right.
So, for a long time, there was this practice of announcing the dividend interest rate,
Yes.
which was
Press
always quoted
releases,
as
the
a
whole
percentage.
nine. Right. Uh-huh.
And it would be something like, we plan to pay a dividend interest rate or an effective dividend interest rate of 7.3%.
Mm-hmm.
And a lot of people stood around going, great, 7.3% of what? And the insurance industry's response was, exactly. But you got to do it right. It's not just exactly. It's exactly. You got to have that smile with the thumb pointed out, or excuse me, thumb up, index finger out, so you can also do the little thing. And the consumer and most insurance agents and brokers sat there still confused, but the industry just soldiered on.
Yes.
Undeterred. The technical answer, as we have given lots of times before, is 7.3% of basically the reserve, which means that 7.3% is a variable for a much more complicated equation.
Right.
So 7.3% of something, but you don't know what, and so you can't really make any substantive decision about what that means relative to anything else you could do.
Right.
Now, the industry for a little while was not directly suggesting that 7.3%, or whatever the number was at any insurance company, was an actual yield comparable to other dividend yields at stock companies or anything like that. But there were many, many people in the financial press who kind of ran with it that way, and the insurance industry certainly didn't do anything to stop that confusion.
Exactly. We're just whistling past the graveyard. We're not gonna. Yeah, they didn't lie about it. It's a lie by omission. There you go.
Depends
right?
on what your definition of is.
I mean, I've been married for a long time, so I've learned that just not saying something is just as bad. So, or so I've been taught.
So we're here now that we've kind of framed that
Yes.
to ask, should we just get rid of it? Just stop it.
Should we just get rid of dividends?
The dividend interest rate.
I know.
Yeah, I know.
I'm trying to spark a little bit of humor here.
Yes.
Should we get rid of the dividend interest rate? I think we should get rid of discussing the dividend interest rate as if it's something meaningful.
There is one useful aspect of the dividend interest rate. We have noted this for years now.
Mm-hmm.
And that one useful aspect of it is we can look at it to make an actual statement about what the effective benefit of dividends paid is per individual policyholder year over year.
Okay.
Let me explain what that
I was about to say, you got some explaining.
because without an explanation, that means nothing.
Right.
If Northwestern Mutual says in 2013 our dividend interest rate is 6.5%, and I don't remember what it was in 2013, it's entirely hypothetical. And then in 2014 says our dividend interest rate is 6.25%. What we know is the effective dividend paid to each individual Northwestern Mutual policyholder has gone down.
Right.
That's what we know.
So
And we can-
So you're suggesting that's about the most useful inference of
Yes.
that statistic, basically.
Yes, it is. So we can use it over time at a specific insurance company and evaluate, has the individual policyholder generally received more, less, or the same over X amount of years.
Right.
We cannot, however, say in 2013, Northwestern Mutual's dividend interest rate is 6.5%, and Mass Mutual's dividend interest rate is 6.75%, and therefore Mass Mutual pays its policyholders more.
Right.
Those two numbers don't compare that way.
Or even bigger. The Mass Mutual policy is better than the Northwestern policy.
Right.
Because that's what clients do. I mean,
Yes.
that tends to be what they decide on their own.
And for years, that's what the industry did.
Yes. Well, as long as you were the one that was
paying
that had a higher number than everyone else, then yeah.
Yes. And for years, AM Best used to track this.
Right.
And they would publish a report once a year comparing every insurance company or not comparing, excuse me. They would report this, and they would show every company's numbers, and the sales department at insurance companies that were on the top of the list would take that information and run with it.
Right. Yes.
It
became reprint stuff, marketing material.
Yes, it did. So that statistic, that dividend interest rate, is useful in looking at what the individual policyholder has received in terms of value in a sequential sense.
Right.
Are they receiving more dividends than they would have expected over the years, fewer dividends than what they would have expected over the years, or the same?
Right.
That's what that number does.
So
for us.
General trends, basically.
Yep.
That's what we've always talked about.
But it does nothing when it comes to saying, okay, well, in this year, Guardian was X, New York Life was Y. X on its face looks larger than Y, so therefore Guardian is paying more than the New York Life. That's not the way you can use the dividend interest rate.
Right.
So our question today is, should we just get rid of that? Because it's kind of like going out and saying, my car has a 17-gallon gas tank. Your car has a 15-gallon gas tank. Therefore, my car is better and it can go further.
Right. Right.
That doesn't translate.
Yes.
So our question is, should we get rid of this reporting entirely? And should we implant some other metric, some other statistic that would allow us to actually make a substantive statement about each individual company across all companies?
Right. Yes, we should.
We should? You think so?
Well, I believe, I mean, look, this is preaching to the choir because you and I have had this discussion, I don't know, 150 times in the past 6 or 7. It seems like every dividend season we have, you and I, at least privately, have this sort of conversation. And we both had it with other, our colleagues as well, in that, the press releases tout the interest rates, the scale, whatever you want to call it. And there's just nothing meaningful, really. It tends to lead to a lot of confusion and misunderstanding.
Yeah.
Or contributes to. I won't say it's responsible for it necessarily, because I think most people in general are confused by whole life insurance. So this just compounds the problem and leads people. What's dangerous about it, at least in my mind, is that it leads people to make incorrect conclusions.
Okay.
And I just don't see that it's all that useful
To publish the information about the dividend interest rate.
No.
Let me ask you a question. Why not?
What have you ever discerned from it? Seriously. I mean, other than the general trend, I concede that.
Yep.
But is there really any other? I can't think of any other benefit.
No, that's it. The trend. We can look at the trend.
Right.
Are dividend payments to the individual policyholder going up, down, or staying the same?
Or my alternative proposal would be, you can continue, life insurance companies, you can continue to publish this information. That's just fine, but you have to give us all the numbers behind the information.
Well, here's the problem in addition to this, because we talked about the trend. Just because we know the trend, we don't necessarily know the overall value.
Right.
So, for example, New York Life, and hypothetical, I'm not sitting on information that would make any of this true. Absolutely. Maybe New York Life's trend is going up,
Right.
while Guardian's is going down.
Mm-hmm.
But Guardian has for years been paying just a much larger amount of dividends to policyholders and delivering more value.
Right.
So while New York Life looks like it's a superstar, things are improving, while Guardians are getting worse, the Guardian policyholder is still doing better.
Right.
That could be a real scenario, but we can't pick that apart from the dividend interest rate information.
Right. Absolutely not. You're correct.
So let me ask you this question. There are some companies, most notably those from the Midwest, who love to report the total number of dividends that they pay each year.
Yeah.
What's wrong with that statistic?
Well, I mean, to me, it goes back to your analogy about the car and the size of the fuel tank. And I'll exaggerate that example because I think it makes even more sense in this context. It's like having a conversation with my friend who owns a 4-door long bed F-250 diesel, as opposed to my Honda sedan, and he brags, "Well, I don't know about you, but I get 900 miles of range to a tank of gas or a tank of fuel," and I go, "Wow, that sounds a lot better than me. I only get like 350." Well, he forgot the detail where he has 95 gallons of diesel fuel or whatever it is. So much so that he has to swipe his credit card at least twice to fill up.
Yeah.
In two separate blocks. So did that really tell me anything? Sure. He can drive from here to what's a good point of reference? From here to New York City.
I was hoping you were going to say
tank
New
of-
Jersey so that he could get out and pump his own gas. Or not pump his own gas.
You can't pump your own gas. You're not
I know.
qualified.
There's a little joke there.
I know. For all of you people who live in that area, I didn't know. I hopped out and started pumping my own gas, and evidently I'm not qualified to do that. So somebody's union thinks that I don't need to pump my own gas. So anyway, can he get to New Jersey in the example on one fill up? Yeah, absolutely he can. Does that make his truck more economical than my Honda?
No.
I don't think so.
Right.
So in the scenario that you're talking about, certain companies from the Midwest love to brag that they had their highest payout of dividends ever. They've paid the largest amount of dividends that's ever been paid by them or anyone else to their policyholders.
Billions.
But they fail to mention that they also have the largest number of policyholders on planet Earth.
Yep.
And I don't know that for a fact. I may be exaggerating. They're in the top 2 or 3 probably, right?
Right.
And they have one of the largest aggregate amounts of life insurance in force on the face of the earth. So it would stand to reason that they would pay more dividends than everyone else. But paying more dividends to everyone else doesn't mean that each individual policyholder receives more value.
Right.
And that's
that's the core
right
of the point here is we want to evaluate value delivered to the individual policyholder.
Sure, because we all work with individuals. No one cares. Yeah. I mean, I don't care if my insurance company tells me how great they are. I care if I see it in my individual cash values or death benefit growth or whatever metric is most important to you.
The fact that Northwestern pays these many billions of dollars in dividends doesn't really mean anything for me, the individual policyholder.
Right, exactly. That is true.
So our contention is we need some way to evaluate how these things are performing on an individual basis.
Yeah.
Now, this sounds great. The problem is the industry will fight this like crazy.
Yes. That is absolutely true.
In the most woe is me way possible, right? Because the life insurance industry is hyper competitive, actually.
Yes.
For an industry that seems very old and boring, there is an unbelievable amount of espionage that takes place, and just crazy amount.
It's called competitive research. Thank you very much.
Yes. Of trying to figure out how to game each other
Right.
when it comes to product development and rollout. But
Well,
at the same
let me
time,
stop you. Is that overblown? I mean, is there some reality to that, to their need to be competitive? I'm going to play devil's advocate.
I think every
for just a
industry has
second.
to.
Right.
I think
But I'm just given the I mean, you don't know what I'm thinking, but given the fact that the one thing everyone always has to keep in mind is that life insurance companies are all using the same data.
Yeah.
So there is no, as in like in the P&C world, Geico versus Progressive. There is a substantial profit that can be made from better or lesser underwriting.
Yeah.
In the life insurance industry, that doesn't really exist. Right? I mean, there's some
smaller
advantage to it.
smaller scale, so to speak, right?
Right.
Because there's certainly a degree of underwriting profitability that can be done from
Absolutely.
Just not being as lenient.
Right. But you're not affected by acts of God where you have, enormous hurricanes that just wipe out things like that. It's very predictable is my point. Now, one company can decide that they want to loosen their underwriting criteria because they need to acquire more premium. There's all of those sorts of things that are controllable, little knobs that can be turned.
Yeah.
But by and large, they're all using the same data.
Yep.
In terms of the mortality experience, I guess.
So the industry wants to maintain incredible competitiveness, all the while saying, "Well, no, we're a collective bunch, and we don't want to fight." And that's.
But this is what leads them to be so secretive about certain components.
Yes.
It's because they believe it's helping them maintain some advantage over their competitors.
There's one other problem with this sort of metric.
Okay.
The insurance industry, the insurance industry, is primarily driven by people who are really, really good at math and logistics and figuring out how to kind of work a system. So I don't suspect it would take long for many of them to figure out how to game this metric.
Right.
And at that point, try to build product or marketing efforts around juicing that metric. And in the insurance industry, really, you can kind of manipulate a metric for just a short period of time, and in an effort to collect enough new premium, then kind of change focus. And it's not that easy for life insurance policyholders to just walk away once the company has decided it's no longer interested in delivering as much value as it did in the past.
Right. Yep. We've seen that happen to people.
So whatever sort of number you want to lay on the table, I think it's actually much more complicated than just a simple metric that says, oh, you can compare this number from Guardian to New York Life to Penn Mutual and so forth and so on.
Right. Absolutely.
And we ourselves have a certain number of metrics that we look at across companies. And it's not as simple as just a number like the dividend interest rate. It's actually a collection of metrics. But we look at those things, and they're much more kind of an income statement type accounting metric, because we feel that those really drive an indication of operational health. And ultimately, that is what will deliver value to policyholders.
Right.
We've made a big deal for years over what I have dubbed the gap between operational cash flow and dividend payments. Some companies pay a substantial percentage of operational cash flow out as dividends. Others don't. One is not necessarily right versus the other, but as we've noted here, not explicitly on the podcast, but definitely on the website, the higher percentage of your net operating cash that gets paid out year over year as a dividend, the less breathing room you have necessarily if operations change.
Mm-hmm.
So if, for example, this is purely hypothetical because the numbers with the insurance industry are much, much larger than this. But if your operational cash flow is $1 million and you go out and pay $900,000 in dividends to your policyholders, you can only take $100 million hit in income before you've got to reduce substantially the dividends that you're paying to policyholders.
Right.
But on the other hand, you make $1 million, and you pay $500,000 in dividends to policyholders. You can stand to lose some money before you really, really have to evaluate the dividend payment.
Right. Right.
Now, there is a certain amount of regulatory obligation when it comes to participating whole life insurance. The number of dividends that gets paid out is not necessarily arbitrary. This is both good and bad. It's good for the policyholder. It's frustrating for management of the company's finances. But all states have a required amount of dividends per se that have to be paid to policyholders of participating whole life insurance from the insurance company. So it's not like the insurance company gets to decide, we made all this money, but we don't really want to share it with the policyholders.
Right. Yes. Well, those rules are set up because of some of the favorable nature that mutual companies undergo, right? The rules
Yes.
are put in place that say, okay, you can operate that way, but you have to agree to pay out, under these, and each state has different regulations about that, but you have to agree to pay out this percentage of your divisible surplus or something like that.
Mm-hmm.
I'm way oversimplifying that, but yeah.
Yep. The other thing that we've spent a lot of time talking about is an insurer's ability to generate investment income over and above its obligations.
Right.
So every time an insurance contract is put in place, there's obligations that come along with that because of the
Sure.
guaranteed features of that contract.
Sure.
And so we're always concerned about how much investment income
Mm-hmm.
an insurer can create in relation to the obligations it has yoked itself to. And if you think about this, this is really a question of how well does this insurer take your money and turn it into something of value above and beyond what they are telling you they're going to do.
Right.
And in a non-mutual, non-participating life insurance world, that metric is not all that important. But in the participating whole life mutual insurance company world, that is dramatically substantial.
Right.
Because that's the whole point. That's the whole point of what we talk about when it comes to using whole life insurance specifically as an asset class. You are giving money to the insurer under the assumption that they're going to do something with it that's better than what you could have done somewhere else.
Exactly. You nailed that.
So we are very much concerned about an insurer's ability to generate income, investment income, over and above the obligations that they have created by virtue of issuing insurance contracts.
Right. And the thing to understand there, little nuance, but I want to point this out, because people tend to think insurance companies just buy bonds. So they're sort of stuck with whichever way the wind is blowing in terms of interest rates.
Yeah.
And there are a lot of them that would want you to believe that right now,
Yes.
in particular.
Yes.
Because it's very convenient
Oh,
for
bonds
them.
are bad. Sorry, guys.
It's Brandon saying that tongue in cheek, but there's a lot of truth to it. There are some companies, we're not going to name names, but we know of some companies that made some really bad decisions. I don't mean bad in terms of insolvency or anything like that. So I'm not trying to exaggerate, but they made bad decisions that have greatly adversely impacted their ability to maintain a competitive level of dividend payouts to their policyholders. They just kind of bet the wrong way on some things. And look, the chickens are coming home to roost for the entire industry with the interest rates being as low as they have for as long as they have, for sure. I mean, there's you can't, there's a certain amount of inertia that you just can't overcome with that. But what I would argue, and I don't know if you agree with me or not, is more important is to evaluate the company's ability to do something better with that money, as opposed to, do you want someone who makes excuse that we're just all being carried away? Or, because, I could take my own money and buy whatever prevailing interest rates are paying right now. I could buy bonds.
I can invest and lose my own money just fine. I've done it
exactly.
before.
I don't need the insurance company to do that for me.
Mm-hmm.
So what alpha are they adding to the equation?
Right.
And that's really it's tough to quantify, granted, but that's really what's at stake here.
Yeah. That is it.
So what do we think? Can there be a universal metric?
I think ultimately any attempt at a simplified universal metric will fail miserably.
Even though you think it's a good idea.
I think lots of things are good ideas.
I know. No. In a perfect
getting
world,
rid of the two-party
hypothetically.
system's a great idea. That's not going to happen. So,
yes, I would agree with that as well.
So, I think as much as it's great, it sounds great, and we could make efforts to try and create that. It'll fail ultimately because just like any piece of legislation in the United States, it'll start really good, and then by the time it gets done, forget it. This is the definition of compromise. Both parties walk away unhappy.
Right. Nobody's happy. Right.
So
yeah, because the unintended consequences of whatever any rule would create would be far worse than what we have now. Most likely.
Yep. But I do think that there are serious efforts that could go into an attempt to evaluate various variables that would allow us to make some degree of substantive statement about the overall health of an insurance company.
Right.
And its ability to return value to policyholders.
Mm-hmm.
I do believe that is possible.
Right.
And I do believe you and I have worked at that, and we've done a decent job at uncovering that. And
well, because ultimately that's the best you can do right now with determining, okay, I've got $50,000 a year that I have sort of earmarked that I think I'd like to pay into a whole life insurance policy.
Mm-hmm.
Which company is giving me the best exchange of value for that
Right.
premium? Right now, looking at the information that we look at, it's the best way that I know of determining, based on this set of circumstances, this company's probably positioned best to return value to you over time, and they also have a history of doing so. Doesn't mean now none of that means that they necessarily will, but it's the best we can do.
In any world, we never know that, right?
We look at the numbers. In any of the alternatives either, by the way. So
we look at the numbers and we make an educated guess based on the math that supports it to say there's a higher likelihood that this will go well than that.
Right. Exactly.
That doesn't mean there's a guarantee that this will go higher, that will go better than that. There's just a higher likelihood that this will go better than that.
Exactly.
And that's always what it distills down to.
Yeah. All right.
Cool. Well, I think on that note, we'll leave it there. So I am Brandon Roberts.